I'm going to call this an update video. And back in January, I analyzed the TSX, the Nasdaq, the Dow Jones, and the S&P 500 using the standard deviation metric. And this is a tool that shows how far markets stray from their historical trends. Now, at the time, if you watch that video, you'll remember that each of these indices were just expensive. They were extremely overvalued. They were extremely stretched, and valuations were well above their normal historic ranges. I warned at the time, or I explained at the time, that markets rarely stay at such high levels for very long. There's some form of correction that will always happen, and it was likely. Now, if we look at today, if we fast forward to today, the markets, in fact, have pulled back. I'm sure that I'm not breaking any news here, but not all of them have pulled back equally. And in the video today, I'm going to do this update. I'm going to compare where we were back then to where we are now and what it could mean for us as investors going forward. I want to take a quick look at how the major indices have performed since that video back in January. So since that time, it was January 25th, the S&P 500 is down roughly 9.5%. Dow Jones is down about 9.7%. The Nasdaq 100 is down around 10, almost 11%. And the TSX is down just over 2%. And you can see that this is after a recent recovery. They have been down lower than this during the 3 months. Before I dive into each of the charts for the indices here, I want to quickly review what standard deviation is, just to make sure that we're all on the same page here. In the simplest of terms, standard deviation measures how far something moves away from its average over a period of time. When a market, for example, like the S&P 500 or like the TSX, when it moves 1 or 2 standard deviations above its historical mean, it tells us that it's getting very stretched. It's very expensive, or it can go below as well. It can become very cheap if it's negative standard deviations compared to normal levels. Now, typically, the further that the prices move from the mean, the more likely it is that they're eventually going to snap back closer to that mean. This is a process called mean reversion. You may have heard of that before. And that's why extreme moves beyond 2 standard deviations are often a signal of higher risks for investors. That's exactly where we were in January. Now, if you would like a deeper explanation of how standard deviation works with investing, you can watch the original video. I will put a link here so that you can review that if you would like. Okay, so where are we today? Let's start with the S&P 500. This is where we saw some of the most extreme overvaluations when we looked at it back in January. So at the time, the S&P 500 was trading well above 2 standard deviations. And again, this is a sign of extreme overvaluation. The index was nearly 80% above its historical mean. It was flashing strong warning signals for a future pullback. Just to point out that it's very rare that we see this move above the 2 standard deviation mark. So that meant that there was significant risk to the reversion at that point. And I suggested that if you're, at all worried about volatility, maybe a defensive positioning stance might be good. Now, today after the correction, the S&P 500 has moved back below the plus 2 standard deviations. It's sitting between 1 and 2. So it's still elevated, but it's not at that extremely high level anymore. Today, I would say that valuations do remain above their long-term averages, but they are healthier than they were 3 months ago. Definitely the risk-reward dynamics that may have improved slightly. But if you are an investor here in this environment, you still need to be very selective. There are probably emerging opportunities that are presenting themselves. Remember, you're looking at probably buying individual securities within the index, so not the index itself. So there definitely will be some opportunities there. As before, though, I would say you want to focus on quality, you want to focus on diversification, and perhaps gradually buying into weakness. Now, I want to move now to the Dow Jones Industrial Average. And you may remember back in January, the Dow was also trading above that plus 2 standard deviations. Again, another sign of stretched valuations. My observations back then was that this index was elevated, vulnerable to a potential pullback. Again, defensive, balanced positioning is what I recommended as a portfolio strategy back in the day. Now, today, the Dow has corrected sharply, as have the other indices for the most part, now moving closer down to the plus 1 standard deviation level. Now, my current observations is that there has been a significant reversion to the mean that has already occurred. So these risk levels are more normal. Still, though, if we look at this by historical norms, the index is still overvalued. From an investor perspective, obviously some of the stocks on the Dow might be offering a more attractive level than they were 3 months ago. Again, I would focus probably on dividend blue chip companies. These remain probably more attractive for long-term investors. Now, I want to shift over to the Nasdaq 100, where back in January, the valuations were even more stretched than these other indices. But please just take a moment right now and let me know if you would like more updates like this as the market cycle continues to unfold. I'd be happy to bring those back on a regular basis. Now, in the Nasdaq back in January, it was crazy, well above the +2 standard deviations. And this was driven, of course, by the tech sector enthusiasm, the momentum that we saw back in AI. My key observations back then is that the markets were extremely stretched valuations. I said the markets, the Nasdaq in particular, had extremely stretched valuations, and it was highly vulnerable to a correction. Now, we have seen a pullback, and the Nasdaq has actually fallen now below the 2+ standard deviations, but just below that. It does still remain elevated compared to historic conditions. Some of the current observations I have, as I say, some of that froth has been removed, but certainly not entirely. Valuations are still relatively high. If you're an investor, here are some of the implications. You have to stay very selective. You want to broaden your focus beyond just the mega cap names if you haven't done that already. Now, finally, let's check in on the TSX, where in January, the index was trading above the 2+ standard deviations. And this is an unusually stretched level historically. Key observations back then, again, the TSX was showing significant overvaluation relative to its long-term average. Defense sector exposure sort of helped keep volatility lower, but the risks were absolutely rising back then. I urged more caution and defensive positioning. Here we are 3 months later. The TSX, interestingly, does remain above the +2 standard deviations. This is the only one of these 4 indices we're still trading at that high level. But unlike the US indices that have corrected quite sharply, the TSX has only seen a modest pullback of about 2%. That's where we are today. It has been down lower in the interim, but today we're sitting at about 2% lower than where it was at the time. So currently here, the valuations, I think, are still stretched compared with these historic averages. The TSX has definitely been more resilient than its US counterparts. So as an investor, that means that the risks of this reversion are still pretty high. I would say they're still elevated, and investors should definitely stay cautious and avoid chasing prices higher. Again, income, defensive sectors continue to probably offer the best relative value. Now, when I look at these 4 in aggregate, most of the markets that were dangerously stretched back in January, they have corrected meaningfully, no doubt about that, but we're certainly not back to cheap levels yet. So, the buy the dip, buy in the pullback, maybe some merit to that, but certainly we're not at a cheap level on any of these indices yet. The extreme risks have eased somewhat, but you should definitely still tread carefully. The exception here is the TSX, which is still trading at the over 2 standard deviation level, so you have to use extreme caution there. As an investor, you want to really focus on selective buying right now. Focus on quality. Focus on maintaining proper diversification. That will probably be one of the keys to success going forward. This is if you're buying individual securities. If you're buying an index, then, well, you're along for the ride regardless of what happens there. Reminder, I guess, that corrections, these are uncomfortable, but they are part of normal and quite healthy part of long-term investing. That's how the markets work. These type of pullbacks, they reset the expectations, they realign the valuations with the fundamentals, and they do create opportunities. If you are a patient investor, if you are a long-term investor, then staying disciplined during these times, obviously, adding selectively, rebalancing thoughtfully, this is where you can really build wealth over time. Thank you so much for watching the video. If you did find this update helpful, please don't forget to like, subscribe, share it with anyone that you feel could benefit from a little perspective right now. As always, thank you for watching. We'll see you again soon.